Hi there, and welcome to our Zoom situation overview, where we explore why Zoom stock is up 154% as of May 15th. What you're getting to see in this video is a live webinar lecture for students in our analyst program on how they can find the information, perform due diligence to better understand this information. So we hope you enjoy the lecture, and let's get to it. Your situation overview has to deal with performing due diligence. What does that mean? You access all public information that we have available from Zoom, like the company website, their press releases, the SEC filings, reading their earnings report so that you can get a better understanding of how they perform in the latest quarter, and just get additional information on how the company is performing from an operational standpoint, and also get a snapshot or their profile picture on the balance sheet, how much cash they have, how profitable the business is, which again gives us an indication of the fundamentals. I always first like to look at the stock. How has the company stock performed year to date when you compare it to the general average, the S&P 500, the NASDAQ, and the Qs? So it's very clear in this slide, Zoom is up 154% year to date. I mean, think about it. While the NASDAQ is up 3.5%, the S&P 500 is down 11%, and the Dow Jones Industrial Average is down 17%, you have one outlier in the entire market, Zoom, up 154%. That means that during this year alone, in terms of market cap, they've increased their value by $29.6 billion, as I'm showcasing right here on my slide. Okay, now here's what's interesting. During the whole market correction, which really started in February and lasted through March because of the coronavirus pandemic, look what happened with Zoom stock. The stock increased 40%. And if you've been following the stock analysis over the last several weeks on Amazon and Netflix, you've also noticed that those companies also outperformed the market. But during the period of the correction, those stocks also were severely impacted. Meanwhile, when you see Zoom, they weren't impacted at all. They actually benefited. And the reason for them benefiting is what's happening with business, employees, and consumers. The change in behavior, the new conditioning is that people are working from home, and employers are learning that their employees are becoming more productive from home. Why is that? If you really think about it, number one, you don't have to wake up early in the morning, get ready to spend an hour or two commuting to get to your job, which means you're wasting time during that whole period that you could probably be using to be more productive from home, working on your assignment or any projects that you have. The other point is video conferencing has allowed people just to communicate as easily as if they were doing it in an office setting. So Zoom has perhaps the best video platform to allow employers to engage in their activity, which again is elevating their productivity. This last week, the CEO of Twitter, Jack Dorsey, made an announcement that said employees from Twitter can work from home forever. So he's the first one now of large tech companies that is signaling that people can now work from home. Now, what do you think is going to happen because of that? Well, other major companies are going to also start to do the same. Again, this will leave a legacy, and the new condition is that working from home is going to be normal. And the benefit from the employer standpoint, because you always have to look at it from different perspective. From the employer standpoint, what do they get? They get to save on their costs in office space. So commercial real estate, that market is definitely going to be under a lot of pressure because they're going to have a lot of vacancies. I mean, there's articles on how the New York commercial real estate market is in a shaky foundation right now because employers may not renew their leases because people are just going to be working from home. Now, from an employee standpoint, from your standpoint as the audience, you're going to notice that working from home might actually be something that you enjoy. Instead of commuting, instead of working next to someone that you perhaps may not have the best relationship with. You rather work at home, spend time with your family, with your kids, and really just be more productive. That is really helping. And that's what I'm also hearing from my friends, from my personal relationships that work in finance. They work on Wall Street. They don't have to be in New York. Some of them are actually working in other parts of the country, and they enjoy that. They feel rejuvenated. They have a better sense of an increase in morale because they're not locked into an office setting. So this is just giving you more indication of what's happening, and Zoom is definitely benefiting from it. I mean, just look at it at the beginning of the year. The stock price was around $70 right here. This is around $70, and right now they're trading at around $165, give or take, in a very short period of time. In the first 1 or 2 quarters, this stock is up 154% because of the change in emerging trend and consumer behavior, and you're seeing it with Zoom. So Zoom is turning out to be one of the winning stocks of the stay-at-home economy. All right, so I hope this slide really helps you understand from a chart perspective what's been happening and the capital that has been flowing into this stock because of their business model, video conferencing application, and the software that they have. What does that translate from a value, from a dollar value standpoint? Here it is. Increase of 29.6 billion. Went from 19 billion in equity value or market capitalization to 48.7 billion. I mean, it's just unbelievable. Now, to drive this point even more, let's look at the next slide. When you compare Zoom stock to other industries that have negatively been impacted by the coronavirus, in this case, the airline, it's such a clear divergence. It's an inverse correlation. It kind of feels like people are selling the airline stocks and buying Zoom stock, okay? It's just the new adaptation of what's been happening with the economy. So for those of you that want to learn a little bit more about fundamental investing, growth investing, and having your pulse on the market real time and not looking in hindsight what has happened over the last 6 months, pay close attention to the stocks that are outperforming on a daily basis and on a weekly basis. Because if you can identify those stocks that are outperforming on a daily and weekly basis, then you can apply this simple 3-step process by understanding the situation, the fundamentals of the business, looking at the future earnings expectations, and coming up with your price target, which should give you enough reason and enough analysis, right, to perhaps buy the stock where you have a 3, 6, or 12 months time horizon outlook on your investment thesis. So this is just quite interesting, when you compare Zoom with the airline stock. And I've seen other people out there and other analysts, saying that you should buy airline stocks because they're going to be around, and, in 10 years, you might make 3, 4, 5 times your money. But what I do ask is, okay, what is your research? What is your analysis? Have you looked at how much debt these airlines really have on their balance sheet? Have you looked at the amount of cash flow that they're generating? Have you looked at their capacity? Do you really understand the economics, the margins, the profitability of each and every one of these companies? What about the maturity that they have on their outstanding senior debt? Okay? If you're an equity holder, you might actually be wiped out. So you need to do your own analysis to determine if these companies are on the verge of bankruptcy. And if they do file for bankruptcy, if you're an equity holder, you're going to get wiped out. What happens is, through the Chapter 11 bankruptcy process, the debt holders, they renegotiate with the management team and the existing, equity holder, whoever's still in there, they renegotiate. So the debt holders, they get a haircut, and in some cases they become the new equity holder, and then the company does a new IPO. So the new equity holders were the existing debt holders, and then they might replace management. They may come up with a new strategy, a business plan to make the company grow, so that the debt holders that are now the new equity holders can participate on the upside and recuperate the amount of money that they lost from the haircut that they took during the whole restructuring process. That's Chapter 11. And there have been several outspoken investors talking about exactly that. Shamad Hapatia is one of those outspoken investors that was on CNBC, and he was exactly saying that. He said that, look, there is a lot of misinformation by the investment community, specifically coming out of Wall Street, that big firms, big organizations, big companies should not be let to fail. And he say, no, they should be let to fail because they're going to go through the bankruptcy process, which is Chapter 11. If this is new to you, do your own homework, do your own research, understand Chapter 11, because it's actually interesting, and it's a whole nother side of finance that most people don't understand. But if you're someone that want a career in investment banking, then something in a restructuring team could be quite interesting. It's exciting to really learn, why did this company fail? What was the economics of that industry? What was the change in consumer behavior? What was the new technology that disrupted that industry, that forced the stock to decline by 99% and then pushed the company into bankruptcy, and now re-emerging, what is the new plan? When you get to see that whole process, it's really a learning experience. So that's a whole nother side of corporate finance and investment banking that I thought I should share to give you more information on the broader spectrum of the world of business and finance. I'll end the session here. We'll wrap things up. I hope you found value in this. I hope this helps you understand the process a little bit more of analyzing stocks, especially after they report earnings. So with that being said, take care, and I'll see you in the next one. Goodbye.